Have you ever thought about the market efficiency of the crypto market? Or do you know about the time-varying efficiency of the crypto market? Crypto enthusiasts. In this video, we will introduce complex concepts of market efficiency, its types, and the time-varying efficiency of a market. Then, we will apply them to the crypto market. Let's first talk about the concept of market efficiency. Eugene Farmer, studying the relationship between information about the stock and the decisions taken by sellers and buyers, explored the concept of market efficiency. However, even he admits that the term is a little misleading because no one can agree on a precise definition or measurement for what exactly constitutes market efficiency. Generally, market efficiency is defined as the extent to which prices accurately reflect all relevant and available information. A market is efficient if the relevant information is available to all the participants. Academically, sometimes another term, efficient market hypothesis, is also used for market efficiency. Put another way, an investor who follows the efficient market hypothesis would not profit from selling overvalued stocks and should not purchase cheap, undervalued stocks with the expectation of making big gains down the road. Strong proponents of the efficient market hypothesis select passive investment strategies that, to varied degrees, replicate the performance of benchmark investments. There are three forms of efficient market hypothesis. The first is the weak form of the efficient market hypothesis. The weak form of the efficient market hypothesis holds that prices may not reflect new information that has yet to be made public, even though investors adhering to it believe that security prices reflect all available public market information. Past information about the prices cannot influence the prices in the coming days. The investors will need new information about the prices so they can make decisions. Given the ability to anticipate what new information might influence prices, a skilled fundamental analyst can select stocks that outperform in the near term under the weak version of the efficient market hypothesis. The second is the semi-strong form of the efficient market hypothesis. This version adopts the same weak form assertions and adds the supposition that any new information that becomes available to the public is immediately priced into the market. Thus, it is impossible to use technical or fundamental analysis to produce excessive returns. The third is the strong form of the efficient market hypothesis. Supporters of this version hold that the current security price incorporates all available public and private information. Thus, investors are not even able to benefit from insider information in terms of excess returns. Empirical evidence suggests that as financial information spreads, it influences stock prices and improves market efficiency. For instance, after the Sarbanes-Oxley Act of 2002 was passed, equity market volatility decreased due to the Act's requirements for increased financial transparency for publicly traded companies. Financial statements were shown to be more credible, which increased the information's dependability and raised trust in a security's stated price. The efficient market hypothesis has been a dominant theory for a long time. According to the strictest interpretation of the EMH, it is impossible to beat the market because stocks are always valued fairly, meaning that it is never possible to purchase cheap stocks or sell them for a premium. Later, behavioral finance arose to refute this idea by highlighting that in times of financial bubbles, crashes, and crises, stocks did not always trade at their fair value and investors were not always logical. The supporters of behavioral finance try to use psychological theories to explain anomalies in the stock market. In 2004, Professor Andrew Lo introduced a new theory called the adaptive market hypothesis, which combined the principles of the efficient market hypothesis with behavioral finance. Lo believes that people are generally reasonable but occasionally exhibit irrational behavior in response to increased market volatility. This may present opportunities for purchases. According to his theory, investor tendencies like overconfidence, loss aversion, and overreaction are aligned with evolutionary models of human behavior that encompass traits like natural selection, competition, and adaptation. During his research, Lo examined the relationship between changes in a specific period, especially the participants' conditions and prices. He explored that during different periods, various factors, including participants, financial and political conditions, and events, influenced the market's efficiency. He believed the adaptive market hypothesis approach is more trustworthy than the EMH because it acknowledges the possibility of human error resulting in arbitrage opportunities that only last for a limited time before using them. Following Lowe's theory, several time-varying market efficiency measures have been created and applied to diverse market classes, yielding empirical results that support the AMH. Let's apply the ideas we discussed to the crypto market. Most economists believe cryptocurrency has an extremely speculative nature and should be recognized as a speculative investment asset. Furthermore, most researchers concentrated primarily on evaluating the weak form efficiency, which suggests that, considering the asset's price history, price changes in the future are completely uncertain. In this context, the crypto market will be considered efficient if all information relevant to cryptocurrency prices is publicly available and accessible to all parties involved in the market. The cryptocurrencies are exchanged in international markets, with distinct market microstructures for each cryptocurrency. Every cryptocurrency has its own unique set of rules, investor types, and sizes. The empirical analysis of numerous studies demonstrates that the state of the market affects the price of cryptocurrencies. It has been observed that there are periods when the linear and non-linear dependencies in the cryptocurrency price movements are higher and lower, respectively. The thorough investigation offers proof of the importance of how market conditions affect cryptocurrency prices. Investor preferences and behavior have a greater influence on the pricing process in cryptocurrency markets than institutional factors do. As such, the influence of behavioral patterns is stronger. Research suggests that the cryptocurrency market's efficiency is on the rise. Secondly, despite the apparent fluctuations in the efficiency market, the evolution of the Bitcoin, Litecoin, and Ethereum markets indicates an obvious move towards increased efficiency. Overall, studies show that the crypto market is efficient according to the adaptive market hypothesis, which says that the market's efficiency level varies over time and is determined by its participants, circumstances, and events. We appreciate you viewing this video. Don't forget to share the video and feel free to express your thoughts in the comments section. Your input is greatly appreciated.